Hey, how's it going, everybody? And welcome back to Income Views. If you're new here, remember to leave a like, subscribe, and hit the notification bell for more. Today, we're going to be talking all about whether or not you should buy index funds at all-time highs. We talk about ETFs. We talk about index funds. We talk about so much across the entire stock market. If you like that sort of content, remember to subscribe. And, because that's really the only way I'm going to be able to continue making videos just like this. We don't do any sort of online classes or any of that stuff. So, really subscribing is pretty much the only way I'm able to continue, at least for now. Who knows what's going to happen in the future? Should you buy index funds at an all-time high? This is a common question among investors, especially when markets have been on a strong upward trajectory and the general sentiment is that stock prices may be overpriced. While the decision to buy index funds at all-time high depends on various number of factors, history and the data suggests that continuing to invest consistently over time is generally a good strategy, even when markets are at record highs. Here's a deeper look at the factors to consider. Time horizon matters. Long-term focus. If you're investing in the long term, buying index funds at all-time highs usually doesn't matter in the grand scheme. Historically, the U.S. stock market, S&P 500, has continued to grow over long periods. So let me say that again. Long-term focus. Retirement is 20 years away. If you buy index funds at all-time highs, usually it doesn't matter in the grand scheme. Okay. So the S&P 500 has continued to grow over long periods, even if it's faced short-term corrections or volatility. Example: if you invested in the S&P at peak of its dot-com bubble in 2000, you would have seen your portfolio decline for several years. However, if you held your position, your investment would have eventually recovered and seen strong gains in decades following. Similarly, buying during the 2008 financial crisis might have been tough, but those who actually held their investments have been rewarded. Number 2 is dollar cost averaging, DCA. DCA strategy. One way to mitigate the risk of buying at all-time highs is through dollar cost averaging. With DCA, you invest a fixed amount at regular intervals regardless of market conditions. This smooths out the effect of market fluctuations over time and reduces the risk of investing a large sum at a market peak. Why this helps: DCA ensures that you're not trying to time the market, quote, which can be nearly impossible to do consistently. Even if the market is at a high point, you're investing gradually and buying fewer shares when prices are high and more shares when prices are low. Historical trends, market cycles. Historically, markets tend to recover after periods of high valuations or corrections. Okay? What else? Valuation measures. It's important to assess market valuations to understand whether the market is exceptionally overvalued at all-time highs. However, even if valuations are higher than historical averages, doesn't necessarily signal an immediate market crash. Often high valuations can persist for extended periods before any meaningful downturn occurs. Rebalancing risk. Of course, we know this. We've been through this a million times on the channel. If you already have a diversified portfolio, adding more capital to your index funds holding at all-time highs could increase your exposure to equities at a point where risk is perceived to be higher. However, if you have a well-diversified portfolio with bonds, international exposure, and other asset classes, the overall portfolio risk may be balanced. Consider whether your portfolio needs to be rebalancing and maintain risk that aligns with your goals. The opportunity cost of waiting, missing out on gains. That's something I talk about a lot. Trying to time the market by waiting for a pullback to buy can be risky. If you hold off and investing at all-time highs, the market can continue to rise, and you may miss out on significant gains as well. And it's something I talk about so much on this channel. about the gains potentially being missed if the quote timing of the market isn't right. So you know so let's just say the S&P 500 is an all-time high, and you decide to wait for a 10% dip in that to buy. That dip may never come, and in the meantime, the market may continue to climb, leaving you with fewer opportunities to invest at lower prices. So ultimately, investing in broad markets, market index funds like the S&P 500, even at all-time highs, tend to be a sound long-term strategy. The key is consistently discipline and staying focused on your financial goals. If you have a long-term horizon and are worried about the short-term volatility, index funds remain a great choice even at market peaks. So there you go. Remember to leave a like, subscribe, and hit the notification bell for more. Thank you.